My first job, though, is to introduce our first keynote speaker, Richard Bernstein. Richard is CEO and CIO of Richard Bernstein Advisors, a company he founded in 2009. Richard has over 35 years' experience on Wall Street and was formerly the chief investment strategist at Merrill Lynch. He has been 18 times he has been voted into the Institutional Investor All-American Research Team, and is only one of only 57 analysts in International Institutional Investors Hall of Fame. Fortune magazine voted him into its All-Star Analyst twice, and Smart Money magazine has voted him into its Power 30. Essentially, this is somebody you need to listen to, okay? That's what I'm trying to say here. He's also written 2 books. The first one on style investing, a unique insight into equity markets, and the second one, Navigate the Noise, investing in the new age of media and hype. And given the fact that we're driven in markets by the latest tweet, that's a very welcome book, and I suggest you read it. I know all of his profits from his books go to charity. So without further ado, please welcome to the stage, Richard Bernstein.
Good morning, everybody. If that biography sounded impressive, I have to admit it's because I wrote it. So is there a flipper for the slides? There doesn't.
Richard?
Yes.
See, Brexit's messed up already.
There we go.
That's the point.
Yeah, right.
Forward and back.
Green is good.
Green is good.
Green is good. Got it. Thank you. Good morning, everybody. Thanks for inviting me. It's great to be here. Thanks to Tom Mahoney, who asked me, it must be like a year and a half ago, to speak at this. And thanks, Tom, for setting this up. It's great to be here. So I just want to start and kind of give you the summary line first, and then we'll go into some of the detail. And I think the way to think about the way at our firm, at RBA, where we are thinking of our portfolios right now, we're thinking that it's time to calm down. It's not time to get bearish. I don't want you walking away from this morning saying that, oh my God, he was so bearish. That's not the story. But the story is it is time to calm down. And you have to realize that, it was pointed out before, we started our firm in 2009, 2010 because we actually thought we were entering one of the biggest bull markets of our careers. It's one of the reasons why we started the firm. And so here we are 10 years later, and obviously the world has changed, and the question is, when do you start calming down? And we think it is time to start calming down. Again, not time to get under your desk in the fetal position. I don't want to over-dramatize it, but it is time to start calming down. And that's kind of the title here, that this cycle's lights are starting to flicker. That's really, because a lot of times people talk about an on-off switch or a dimmer switch or something, and I don't quite know what the appropriate analogy is, but I can tell you the lights are starting to flicker. This is not as healthy an environment as people think, or from an investment point of view, right? Which is all we really care about. We don't really care about the economy. We care about the investment side. And you know, the time to really be bullish was in 2009, 2010, not today, right? There's a big difference between what's going on today and what was happening in 2009, 2010. And the opportunities were abound in 2009, 2010. And I would argue they're getting slimmer now. They're not gone, but they're getting fewer and farther between. So these are kind of the summary bullets that I want you to take away. It's late cycle, not early or mid-cycle. I can't believe that people are even arguing this, that we might be in a mid-cycle environment. Some people are actually saying we're in an early cycle environment. That to me seems ridiculous. We're in a late cycle environment. We could argue about how long the late cycle is going to last. That's a different story. But to think that we're in a mid-cycle or early cycle, I just think you can't be looking at the data to suggest that we're in an early cycle environment. That's kind of weird. Monetary and fiscal policies are on hold, but unlikely to tighten. I think that's kind of where we are right now. We're kind of in limbo in a lot of policy. Liquidity is drying up, but it is not yet arid. Right? We're not in, I'm going to show you in a second, liquidity is drying up. It's one of the reasons volatility has begun to go up. But we're not in a desert for liquidity yet. And investors are incrementally bullish, but they're not euphoric. Right? So if you think about what causes a bear market, it would be the extremes of those three things. What you would find is you would find very tight monetary and fiscal policy, you would find an arid liquidity backdrop, and you would find people bullish as all get out. We're not there yet. We're moving in that direction, but we're not there yet. So the question is, do you get more bullish or less bullish as you move in that direction? So the question that everybody always has to ask, and that we always ask, is why are investors max bullish at the end of a cycle? Why in the bottom of the ninth inning with 2 outs and 2 strikes on the batter are people max bullish? That doesn't make any sense. And I wrote in here, be honest, are you more bullish today than you were in March of '09? Of course you were. Most people are, right? And that makes no sense to us at RBA. How can you be more bullish today than in March of '09? As I said before, the opportunities were huge in 2009, 2010, 2011, and they're slimmer today, but yet people are more bullish. So that's the question, and at RBA what we try to do is we're in what I would call a natural process of calming down, right? It seems very normal to be doing that. We've reduced equity in virtually all our multi-asset portfolios, but we're not underweight equities. Again, I don't want you walking away saying that, oh my God, he's so bearish. No, the story is we're calming down. Let me put some numbers on that for a second just to give you, in our flagship fund, our biggest fund, we were for most of the cycle roughly, let's say 70-75% equity, 65-70-75% equities. We're now down to 55% equities, and the benchmark is 50 in that multi-asset fund. So you can see how bullish we were. You can see we're still overweight equities, but that fund is allowed to go all the way to 25% equities. So you can see we're not there, right? So I'm trying to give you a range so you can understand where we're sitting here and what I'm talking about. So the number one investment issue in the United States for 2019-2020 is corporate profits are decelerating in the United States. This goes back to work that we did at Merrill Lynch in the early 1990s, which was later put into a book that was used in the CFA all the way back in 1995. And what it basically got at was that it's profit cycles, not economic cycles, that drive financial markets. And you can see how influential that book was, in that nobody ever talks about profit cycles and people always talk about economic cycles. So it was really had a big impact on CFAs around the world. But the point being, and this gets to the heart and soul of equity investing. When I used to teach in the grad school at NYU, I used to ask the MBA students, what's the difference between the stock market and a horse race? Now, an MBA student should be able to answer that question very easily. It's really a pretty simple question, but nobody could. They always had a lot of trouble, and people have a lot of trouble doing that because we do equate the two. We think of the two as the same, and in fact, we even use some of the same terminology. We say, I'm making a bet on Amazon, or I'm making a bet on Sears, or whatever. But, you can see people use the term bet. You're not making a bet. That's completely wrong. People forget why it's even called equity. It's called equity because when you buy shares of a company, you become a partial owner of the company. And as a partial owner of the company, all you care about is the profitability of the company that you own. To sound harsh for a second, it's not a social welfare experiment. You don't care about GDP. You care about the profitability of the company that you own. And so what you find is, and what this research showed in the early 1990s, was that all those market segments people like to talk about, large and small, growth and value, all those type of things, what causes the rotations back and forth are the profit cycle. And profit cycles tend to boom and bust more than economic cycles, and they tend to have shorter periodicities than economic cycles. So they're very influential. But what does everybody talk about? GDP. Look at what everybody's arguing. Is it going to be 3% GDP or not? Who cares? For everybody in this room, I would say it's a completely irrelevant discussion. What you should care about is what's happening to corporate profits. That's much more important for your investment portfolio. And let's put some numbers on that. So on a GAAP basis, fourth quarter 2018 earnings growth for the S&P 500 was between 20 and 25%. It's our forecast at RBA that fourth quarter 2019, in other words, 1 year later, profits growth will be between 0 and 5%. So going from 20 to 25 to 0 to 5. A pretty significant deceleration in corporate profits. You can see that in the chart. Those are the red bars on the right. So I think that's very important. So the question is, what works when profits are decelerating? And the answer is that stable, high-quality companies outperform in that environment. Now, why is that true? Well, rather obvious statement that I'm going to say here. The cycle, by definition, is determined by cyclicals. So when the profit cycle heats up, you want to have cyclical exposure in your portfolio. When the profit cycle slows down, you don't want to have cyclical exposure in your portfolio. Guess what's starting to happen? Everybody hates healthcare. Oh, all the policy, everything's going on. What this chart shows you is since the reporting period began, healthcare is outperforming technology. That's exactly what history says should happen when the profit cycle starts to decelerate. Already, profits growth has gone from that 20 to 25 to roughly 16 to 18. And as that began to slow down, sure enough, more stable, higher quality companies outperform. And that's starting to happen again. It's starting to happen again. So, and you can see this already. And by the way, that trough is exactly the day that Alcoa reported. You know, the normal kind of kickoff for the earnings season. That is the day that trough occurred, right there. So I think there's really something going on. I think history kind of supports the notion that quality and stability are really the key things. Now, some people say to me, oh, well, everybody's talking about quality. No, they're not. Not at all. Not at all. How do I know that? Because when you hear people talk about growth and value, they're missing the point, right? We all know technology dominates the growth universe, but what people don't understand is that technology is much more cyclical than people think. Always has been and is continuing to be so. Don't fall for the story that software is less cyclical than hardware. That's what people say at the peak of every cycle, and the reality is software may be less cyclical than hardware, but food stocks are less cyclical than software. And so what you find is technology underperforms, right? And so people know that, and they know that the growth universe is dominated, but then people look at the value universe, and they say, well, we want value over growth. What they don't realize is the value universe is dominated by financial stocks. Financial stocks also are very cyclical. I really endeared myself to Merrill Lynch management one time when I said in front of the board that Merrill Lynch was just like Alcoa, except we wear suits. And because our earnings stream was just as cyclical. We had a stronger, obviously, secular growth rate, but we were wildly cyclical around that. And as you can imagine, the CEO did not appreciate that. But I think that's what people forget. So why do I bring this up about growth and value? Well, financial stocks, which dominate the value universe, are the second worst performing sector in the United States when profits decelerate. And technology is the third worst performing sector when profits decelerate. So what people are arguing is, do they want the second worst performer or the third worst performer? Don't tell me that people are focused on quality and stability of growth. The growth and value discussion completely is looking at two cyclical groups, and which cyclical group do I want to own? At RBA, we'd argue you don't want to own either. So here's something to think about, and you know, I don't put this up as a political statement. Please don't misunderstand the point. At RBA, we're very dispassionate about our politics. We all have views, 5 o'clock, we go for a beer or something, we all have our views, but 9 to 5, we're all very dispassionate. And the reason we're dispassionate about that is you have to remember that politics is about what should be, right? Remember Herbert Hoover, chicken in every pot, car in every garage. It's about what should be. It's some better version of life. And investing is about what is. It's a very subtle but a really important difference. Why investors listen to Washington is another thing I never understand. Because politics is about what should be and investing is about what is. And so when I show you this chart, this is not a political statement. This is the reality of what is actually going on. And what this shows you is the Nfib Small Business Uncertainty Index. It's something that they derive from all their other indices and surveys that they do. The Nfib is hardly a left-wing organization, if any of you know. They're if anything, considerably right of center. So this, again, is not a political statement. Notice where this sits relative to history. It is at an unprecedented period of uncertainty relative to the history. And if you can't see this, this goes back to about 1988. We've never had a period in this measure of uncertainty. And there's other ones that are like this, that show the exact same formula. You could argue that maybe they're a little more politically motivated in things, but you find this in a lot of different uncertainty type indices. So why is that important? It's important because uncertainty means you should have lower valuations, right? There's got to be a higher risk premium. And I don't think people have come to grips with this yet, that what uncertainty means. And uncertainty, people have forgotten, this level of uncertainty is starting to hamper corporate planning. I can give you a personal example. In our firm, we were thinking about moving to a larger space and paying more for rent, and we nixed it. We decided not to because the range of outcomes was so uncertain for us, we thought that it was too big of a risk, and we decided let's just cram more people into the same room and in the same office, rather, and keep doing that. That's going on in a grand scale. If you look at what CFOs are doing and things like that, it's starting to happen to the whole economy, right? Certainty leads to higher multiples, higher investment, cheaper cost of capital, not uncertainty. And this kind of shows that we're in a period of uncertainty now, historical period of uncertainty. This is another one. This is the U.S. Economic Policy Uncertainty Index, but this is focused just on trade. And this is done by certain academics. I pulled the second because I don't want you to think that this is politically motivated either versus the other one. And you can see the only time that we had more uncertainty about trade was actually when globalization started. When we started with NAFTA and everything else, with a huge amount of consternation among people. I'm sure you remember the debates between Al Gore and Ross Perot and all those kind of things that were going on. You can see the impact that that had on uncertainty. And then you have today, where you have it as well. And that latest reading is through April. I'm going to guess the May reading, call me crazy, is going to be higher, not lower, in terms of trade uncertainty. But I think, again, think of what uncertainty means, what it means to corporate planning, what it means to valuations. And it's happening. Here's, and I'm not trying to over-dramatize this, this is the capital goods book-to-bill ratio. And you can see that it's not quite as robust as some people would lead you to believe. It's not horrible. I mean, I'm not saying it's dying. No, it's not. But it's certainly not booming by any means. And I read another article this morning that talked about how capital spending is booming. I'm not quite sure that's quite true. It doesn't look to be true here. And theory would argue that the more uncertainty, the less capital spending you're going to get. So here's something that really argues that we are in real late cycle. And I read something, and I came up with this chart recently because I read something from an economist on Wall Street who I have great respect for. I've known this economist for almost 40 years, I would say. And he's very thoughtful, and we subscribe to his work, and he's wonderful. But he wrote something that said that it looks more like an early cycle than a late cycle. And I was like, I'm going like, what? How can this be? And so here you are. So the arrows, the green arrows that point up, show you what the yield curve looks like in an early cycle environment. It's very, very steep, right? It's steep because that steepness in the curve encourages lending. It begins a credit cycle. It's a forecast of future nominal growth. It's a forecast of future profit growth. And there's many different ways to look at it. And that's the green arrows are what it looks like in an early cycle environment. And the red circle on the right is where we are today, which looks more like a late cycle environment. And I think right now, people are again missing the point with the yield curve. And they're saying, well, the only reason the yield curve is inverting is for technical reasons. Now, again, that's another phrase that you'll hear every time the yield curve starts to invert, is people say it's only technical reasons. There's always a technical reason, of course. It doesn't just magically invert. And then people say, well, it's only because of QE. And QE has distorted the financial markets. And maybe that's true, maybe it's not. My answer to that is, who cares? The curve inverted. And it's not a magical thing that says, oh, curve inverts, you have to have a bear market and a recession in subsequent number of years, or months rather. It's not magic. There's an economic reason why that happens. And the reason is that when the curve inverts, your cost of funding is higher than your anticipated return in the credit markets. And so you don't lend anymore. And you begin to shut down the lending process. It makes no difference why the curve inverts. It inverts. And it takes a while. It doesn't happen. It's not like the curve inverts on Monday and the recession starts on Tuesday. It takes a while because that has to filter through, and people have to realize that their anticipated return is negative relative to their cost of funding. And that's beginning to happen. That's beginning to happen. There we are. This is a diffusion indicator that we have that comes from the Fed survey of senior bank lending officers. As the line goes up, they are tightening credit conditions. Look what's happening. They are tightening credit conditions. Exactly as history would suggest they should be with a flat to inverted curve, right? They begin to take less risk, not more risk. And here you go. There it is. It's happening again. So, we could argue all day long why the curve is inverting. That's like how many angels dance on the head of a pin. Who cares? The reality is the pin is sharp. The reality is the curve's inverted, and the credit markets are starting to adjust to that. Are people getting more bullish? Yes, they are. This is a survey that we've done, goes all the way back to when I was at E.F. Hutton, for those of you who remember E.F. Hutton. It's a survey of Wall Street recommendations of what asset allocation should be. And what the blue bar across the top is the traditional equity benchmark of 60 to 65%. And what this measures is how much of a multi-asset portfolio should be in equities, right? And the traditional thing was always 60 to 65%. You can see throughout the whole bull market of the 80s and the 90s, they were never recommended overweighting equities, which is pretty extraordinary. The only time that they did recommend overweighting equities was during the tech bubble and immediately thereafter, just in time for the lost decade of equities. And through this whole cycle, we've been below that allocation again. But the point I want to make is that notice that we're pretty much at a high for the cycle, that people are getting more bullish. Again, they're not overweighting equities, they're not euphoric. I'm not trying to make more to this than it is. But you can see that people, as we get to the later innings of a bull market, people are again getting more bullish. Will they ever get euphoric? I don't know. Who knows? But they are getting more bullish. So you can see that the transformations that are going on in terms of earnings, in terms of liquidity, in terms of sentiment as well, that's arguing that we're in a later cycle. So in the United States, we're very focused on stability and quality because the profit cycle is decelerating, right? I think that's really the key thing for U.S. portfolios. Our cyclicality in our portfolios is all outside the United States. In fact, it's all in China. That's where we are. Why? Think for a second. China is the only major economy that is actively applying monetary and fiscal stimulus. And not only are they applying it, they're applying it big time, right? Pedal to the metal, monetary and fiscal stimulus. Obviously, they're trying to fend off the trade issues and things like that. I get that. But what that argues is that, economics 101 is going to work. I mean, every time at the beginning of a cycle, why are people not bullish at the beginning of a cycle? Because they don't believe monetary and fiscal policy are going to work. Why aren't people more bullish on China? They don't believe monetary and fiscal policy is going to work. But what this shows you is leading indicators around the world. Leading indicators around the world. I'm going to talk about that in a second. Leading indicators around the world. And it looks at their momentum. So if you're above the line, your leading indicators are not only strong, but getting stronger. And if you're below the line, they're getting weaker, right? And you can see where China is, and you can see where the U.S. is. That's why all our cyclicality is in China, and we're very defensive in the United States. That's a good way to think about it. Now, why did I harp on leading indicators? I harped on leading indicators because for some reason investors have a habit of looking at lagging indicators. I never understand this, but it's still. And so I'm going to give you a couple of examples. And just think of how much time, whether it's CNBC or Fox Business or whatever you listen to, think about how much time Marketplace and NPR, right? I'm trying to get the whole spectrum here. If you think about how much time they spend on the lagging indicators I'm going to name, and then I'm going to ask you to even think about if you know one leading indicator. So here are 3 lagging indicators. Tell me if I'm crazy at how much time people spend on this. Inflation, the unemployment rate, and my particular favorite, the Fed. Think about how much time everyone spends talking about those 3 things. Now let me give you 2 leading indicators. Weekly initial jobless claims and building permits. Now, I love Rick Santelli, right? I'm a contributor at CNBC, truth be told, and I love him, right? He's very animated, he's great, fine. But how much time does Rick spend on inflation, unemployment, and the Fed versus building permits? I'm not sure I've ever heard him say the word building permit, right? How much time does anybody spend looking at building permits? Have you ever seen a chart of building permits? I bet you haven't. But it's a leading indicator of the economy. And nobody does. So what we do is we look at leading indicators all around the world. It just seems to make sense. And that's what you're seeing in this chart is, roughly the 20 countries or so that we look at, what's going on with their leading indicators. And again, just the point I'm trying to make is look at where China is and look at where the United States is. So the key points, and we may have a couple of minutes for questions. The U.S. is in a late cycle environment. Profits are slowing, liquidity is drying up, and investors are getting more bullish. But again, I don't want you to leave this thinking that RBA is wildly bearish. That is not where we are. We are simply calming down, right? Profits growth is slowing, but we're not in a profits recession. Liquidity is drying up, but it's not arid. Right? Investors are bullish, but they're not euphoric. Right? We got another step to go. As I said before, we're at 55% equities. We could go to 25 if we wanted. So, but we're not at 75 anymore. So you can see the process of what I'm trying to impart upon you, that things are changing. Stability and quality tend to outperform during late cycles and recessions, right? It just kind of makes sense. Relative earnings, if you're my age, you probably remember people used to talk about relative earnings all the time. The relative earnings of stable companies go up when profit cycles decelerate and during a recession, and relative earnings drives relative performance. And number 3, China is the one major country aggressively stimulating its economy. Have faith in economics 101, right? Again, at the beginning of every cycle, people say, that's never going to work. They have too much debt. So let me finish up with this again. Why are investors max bullish at the end of a cycle? Don't get caught up in the hype. Stay sober and dispassionate. And I think that's really important because I don't believe for a second that what I just told you is consensus. People talk about quality in equities, but yet they're talking about growth and value. People talk about quality in fixed income, but what are people buying in fixed income? Institutions are buying distressed debt and private debt, hardly high-quality stuff. That's the lowest of the lowest of the lowest stuff. What are individuals been buying? They've been buying bank loans and floating rate. Again, the lowest of the lowest of the lowest quality stuff. People's portfolios are not high-quality oriented. They are not defensively positioned. They're not looking to get defensively positioned at all in an environment where things are slowing down. Rather, they're getting more bullish because they're chasing past performance. Remember that we've been in 3.5 or 4 years of an accelerating profit cycle. Think about what people were saying before that profit cycle started. They were talking about like profits never coming back and about how risky all these things that are now mainstream were. That's not what they're talking about today. And so I think it's just a natural process, an ebb and flow, where if you have any contrarian streak in you at all, and you think about what drives asset returns, you have to be calming down in this environment. Again, it's not a dire environment. You shouldn't be under your desk in the fetal position. There's plenty of opportunities. But I think it's a very rational way to think of the world. So if there's any lawyers, this is really for you. Make sure you, I'll leave this up just in case anybody wants to take it in. And I think there's actually a second one. Yeah, there you go. So anyhow, we do have about 5 minutes for questions. Yes? Yes. We do have about 5 minutes for questions if anybody wants to ask anything about anything I mentioned or not. Okay. Yes, sir.
How much of the slowdown in earnings do you contribute to the year-over-year comps and in particular the tax stimulus?
Yeah, so the question was, since it's not a microphone, how much of the slowdown in profit comparisons is how much of the slowdown is simply due to comparisons, how much is due to the tax cut? A good chunk of it is, absolutely. I mean, the tax cut extended the profit cycle, right? It was our original forecast was that the profit cycle would peak out in roughly 4Q 17. And then we had the tax cut, and it actually pushed it out by a year, which was great, kept everything going. The problem now is, what do you do for an encore? And then everybody always talks about, the beginning of a cycle, people say, it's only easy comparisons that are causing it. And Whoa. That was pretty good. Okay, now that might have gotten you under your desk in the fetal position. But anyhow, we were talking about profits a long time ago. And so a lot of times people say early in the cycle, it's only easy comparisons. At the top of the cycle, they talk about how it's just hard comparisons, but profits are still good. And that's true, but the problem is every cycle ends with tough comparisons. Every cycle begins with easy comparisons. So it's not just the tax cut. A couple of other things I would put on there is the dollar. The dollar is not accelerating dramatically, but it's up about, let's say roughly about 7% year on year. That's a drag on multinational earnings. It's not horrible. By the way, anytime the DXY index goes up 15% year on year, anytime that's happened, you've had a profits recession within 1 to 4 quarters thereafter. So again, it's not dire, but you can see it's getting worse. So it's like 7%, 8%, we're about halfway there. You've got that. You've got labor costs going up, obviously, which everybody talks about. You've had not a lot of pricing power, which everybody talks about. There's no inflation, right? So we know wages are going up. We know there's not a lot of pricing power. That argues margins are under some pressure. You've got all these little things that are not dire, but they're all contributing to the slowdown. So So we have 5 minutes and 26 seconds, it says right here. I can't, if anybody has.
Hi, can you hear this?
I hear you. Maybe. Yeah.
Microphones.
Okay.
Oh, I'm sorry. The question was that I showed the 3-month to the 10-year. It doesn't make any difference if you do 2-year to 10-year, 2s to 10s instead of 3-month to 10-year. And the answer is a little bit tomato, right? I mean, they both kind of give you the same signals through time. It's just a question of the timing, which one goes first, which one goes second. Usually 3-month gives you a little more headwind, a little more time to prepare. But again, it doesn't. The important thing is not that the curve inverts on Monday and we get a bear market on Tuesday, which is what a lot of people like to talk about. It's really just that it's beginning to tell you that the credit markets are getting tighter, right? And the combination of a credit market getting tighter with profits decelerating, is really a bad sign for lower quality credit, right? I happen to know there are a few people coming up later that love low quality credit, but I'm just going to throw that out there. It's not the right time of the cycle for low quality credit based on history. So, does it make any difference? I don't know. Should you feel better that 2s to 10s are still positively sloped versus 3-month to 10-year? Maybe, but the point being you shouldn't get more bullish, right? As we're almost inverted, and then as we do invert, you don't want to get more bullish in that environment. That doesn't make much sense. The time to be max bullish is when the curve is extraordinarily steep. By the way, the curve in China, has been steepening, just as an aside. Yes, sir.
Could you comment about the U.S.
Uh-oh, here it comes.
There's a microphone. Could you comment about the potential,
I'll repeat the question, don't worry.
the potential U.S.-China trade agreement and how that might roll through corporate profits both in the U.S.
Right. So the question was about the U.S.-China trade agreement and how that's going to affect corporate profits both in the United States and in China. First of all, the reality is I don't think anybody knows what's going to happen, right? I mean, you're a better man than I if you can figure out exactly what's going to happen with all this. But I think the way we're working at RBA, we're assuming it's going to last longer than people think. I think people have an idea that this is going to end by the end of 2019 at the latest because 2020 is an election year for us and Trump's going to want to finalize it by then. I would argue the Chinese do not want to do that. They want to do the exact opposite because their negotiating power goes up as you go into 2020 and they're kind of a command economy and they don't have to worry about an election. So, it's in their best interest to kind of wait. What is going to happen and what happens to corporate profits? Look, it depends on what really goes on here. Let's take what I would consider to be a very bad scenario where we start putting massive tariffs on anything that comes from China. Okay, well, one, that might be good for places like Mexico and Vietnam. I get that, and that really might be good for them. The unfortunate thing is they don't have the capacity to make up for China. China's way too big. They don't have the population, they don't have the capacity, they don't have anything to make up for that. And I think people forget that. So there may be an opportunity to play some other emerging markets, but it's like putting a Band-Aid on a wound, on a serious wound. It doesn't really do an awful lot. The broader these things get, the broader tariffs get, and the more meaningful they are, the more you will see it start hitting consumer prices, and the more you will start seeing it hit a lot of the broader economy. And I would argue one of the reasons we haven't seen that yet is because of a certain substitution. No, the trade deficit has gotten worse, not better, since we started doing this, which implies that we're buying goods, and there's no inflation, so that would imply that either corporations are taking it on the chin and squeezing their margins, or we're just buying more goods from a broader range, and that doesn't create jobs here and all the things that it's supposed to do. So this is the problem with tariffs and why economists don't like tariffs. Not a political statement, an economic statement. I think that there's right reasons for what's going on, but the method of how we're going about it, I think, is personal comment for a second, extraordinarily ham-handed. Extraordinarily so. I just don't get it. So I think it's, again, if you think about uncertainty, I showed you the trade uncertainty index. The only time it was higher was with NAFTA, and that was kind of the good side. but now we're on the other side. So we have time for maybe one more, if anybody. Yes, sir.
So, just a day or so ago, Johnson & Johnson went on trial in Oklahoma for their reported role in the opioid crisis.
Mm-hmm.
And a couple of months ago, Bayer's Monsanto product Roundup went on trial, and there's already been some judgments against them. Those share the common feature that they're both highly regulated products.
Right.
And if the lawyers are successful with those two suits, does that significantly lower the bar for product liability? And to your point on profits and profit recession,
Right.
huge, huge cost, and already something that makes us uncompetitive in the U.S.
Yep.
Does that change things?
It could. I'll tell you, as a Jet fan, unfortunately, the bigger issue with Johnson & Johnson is that the Johnson family owns the Jets. And they have to be about the worst owners in the entire NFL. But that's just a personal comment there for a second about them. If anybody here is a Jet fan, you know exactly what I'm talking about. But look, the litigative nature of the U.S. economy is, I think, unprecedented around the world. I'm not sure you're going to find that anywhere. And, you know, this is, again, not a political statement in any way, because depending on which side of the coin you come down on, you may differ on this. But I just think we have, the balance has gotten, let's put it this way. If you don't want regulation, you end up with a litigative society. If you don't like the litigative society, you want more regulation. That's the trade-off, and I don't think people realize that. That you can't have no litigation and no regulation. That just doesn't work. That's called, free-for-all. So if you don't like regulation, you're going to get the litigation. If you don't like the litigation, you're going to get regulation. It's like there's a balance there between the two. I don't think people understand that balance. That's the way I would say it. But, you're right. If you just let it go and you have this huge litigative cost, that could be huge. But that may be a result of not having the regulatory costs, right? It may balance out. So anyhow, I just want to say thanks again to Tom Mahoney. I don't know where you are, but thanks for inviting me. Thank you, Tom. Thanks for inviting me. And I hope that was helpful, and I hope you enjoyed the rest of the conference. Thanks so much.